When we look at 2025, it really was a continuation of what we saw from 23 and 24. We saw strong double-digit US equity returns across most major market indices. It continued to be led by large cap stocks and technology stocks. And while mid-cap and small-cap stocks performed decently, they lagged. 2025 on paper will look a lot like 24 and 23, but really it was a tale of two periods. In the first 3.5 months, there was a lot of uncertainty around trade and tariff policy. It was really a trying time that stressed investors. We had bear market-like drawdowns in the stock market. However, since April 9th, there was a massive rebound in stocks, and that followed through the end of the year, and that was really led by AI coming back into investors' focus, better than expected outcomes on trade, and corporate profits resuming their march upward. We continued to see narrow market leadership in 25 as we saw in previous years. The largest driver of the stock market returns remains the massive build out on AI infrastructure. Investors have been borderline euphoric about the prospects there. We at Fenimore actually own some businesses, a handful of companies that did benefit from AI. We owned these businesses before it was known that their solutions would be central to AI infrastructure build out. We did not decide to chase some type of thematic tailwind. When you have a few years of strong equity returns, historically it's not been unusual to see investors really move out on the risk curve. And I think we saw a risk on appetite take fold and a bit of speculative behavior. When low quality does well, the high quality factor tends not to do well. And we saw that sort of transpire a little bit. During these types of market periods, I think it's really can test an investor if they can stay disciplined to their investment philosophy. And it's actually quite easy at Fenimore because our philosophy has been rooted and grounded in 50 plus years of investing in different market cycles, different economic cycles, different technology cycles. We don't get to just invest in bull markets. We want to preserve and grow our clients' capital in all markets, and that really is what underpins our investment philosophy. For specific details on each strategy, and in particular company analysis and what transpired throughout the year, I would encourage any investor to please read our Fam Funds 2025 annual letters. When I look ahead to 2026, there's probably 4 different factors I'm looking at. I think the first is AI investment. The second is the starting point of valuations and earnings growth expectations. The third has to do a lot with just macroeconomic indicators. And the fourth, and most importantly, is what are we hearing from our companies? On the first one, AI investment, the question will be going forward, when you take into account the trillions of dollars that are being spent, is this being justified by adequate returns? Don't know if that question will be answered in 2026. I think the downside risk for businesses is still to underinvest in AI than to overinvest. However, when it is asked, and if the answer is they're not generating an adequate return, what will that do for stock market returns given AI's leadership? On the second point, valuation and earnings growth. When you think of a return in any given year, it's really a function of just what are we paying and how fast are the earnings growing. Right now, corporate earnings look very robust. We've had 3 straight years of strong equity returns, and we tend to see valuations get stretched this far into bull markets. This is no different in the case in the start of 2026. Currently, the S&P 500 is trading at about 22 times forward earnings. When you look across history, that's at the top of the bandwidth that we historically see. We've seen this before in 99, 2000, 2021 to give you a sense for where valuations are. It probably means valuations won't be a tailwind for returns from this point going forward, but how long will it sustain will be largely dictated on how long corporate profits continue to exceed expectations. On the third front, macroeconomics, there's a number of things that we are looking at. We're always focused on interest rates and inflation. The economy has mirrored the stock market in that it's been uneven. From a positive side, we continue to see robust GDP growth, and in fact, consumer spending remains incredibly resilient. But if you look at other areas like housing, we're at historical lows for turnover on existing and new. Industrial activity has been muted for 3+ years from US manufacturing standpoint. And then the job market, I mean, we are in a healthy spot. We've never had more people employed than we did in 2025. However, the pace at which we're adding jobs is clearly decelerating. If that continues to soften, what does that do to the consumer spending environment? The fourth and most important factor for us is the commentary that we're hearing from our companies. Now, at Fenimore, we employ a first-hand research process. We go out there, we're seeking to find these high-quality businesses. And when we say high quality, we're talking about businesses that are growing, generate a lot of cash, are financially durable, and are run by really capable management teams. And part of that first-hand research process means getting out on the road and talking to every single company we own on an annual basis, as well as dozens to hundreds of other businesses in some fashion throughout the year. And the commentary that we're hearing continues to support, pretty constructive backdrop. The demands have held up across the board. The businesses are having opportunity to reinvest organically, inorganically. In a lot of cases, we believe these businesses are maintaining, if not strengthening, their competitive advantages. And so while in these narrow markets, in risk-on markets, these types of businesses tend to be out of favor. It's these types of interactions and comments that we get from businesses that really give us confidence that they seem to be positioned well for 2026 and beyond. We hope this recap and outlook were helpful. We would love to hear from you. So please, if you have any questions or need any assistance, do not hesitate to reach out. Thank you.